everyone. This is a repeat of the session that I did this morning. So I'm Nicki Kinton. My business is Confident Cashflow, and I help businesses to get paid on time. As in keeping with the theme, we're going to do that brilliantly. So the session is all about the things that you can do to prevent late payments. So it's not about credit control per se. It's about all the other activity that you can do around the granting, monitoring, and control of trade credit. So where are we at the moment then? So unfortunately, the UK has a culture of late payment already. The government is working to try and do something about this. There is also the Office of the Small Business Commissioner, who is responsible for dealing with any complaints against larger businesses from smaller businesses about unethical payment practices. So it's tasked with monitoring really those businesses that are classed as large within the UK framework, and that only accounts for about 7,600 businesses in the UK. So really, those of us that fall into that small and medium category, we need to do more ourselves to try and combat late payment, because as you can imagine, most payments will be being exchanged between those small and medium entities. Higher energy prices are expected to push up inflation. It may not be to the full 13% now with some of the things that are going on, but it's certainly going to be pushing that up. And the Bank of England is predicting that we will enter a recession by the end of this year. Although there was a little spark of good news in that Q2 of this year actually showed a small growth rather than a contraction, which was originally predicted. So maybe the recession, it won't be as bad as we expect it to be. Interest rates are rising, and they are likely to rise again in November. And just to give a bit of an indication of where businesses are currently at, so 12% of bounce back loans are in arrears already. And the average arrears for CBILS is 164k. So that shows you, let's say, that businesses are already starting to struggle. And business insolvencies are on the rise. We've just had one thing after another hit us in so for some, those loans were maybe pushing the inevitable further down the road. But from our perspective, even if our business is doing okay, we are likely to come across more and more businesses who cannot pay us because of something that's happening in their business. Or we might find actually that some of our suppliers go out of business and stop supplying, so we need to make sure we find alternatives. So how can you protect your business? So first of all, big thing is focus on the cause, not the symptom. So late payment is not the problem. Late payment is an indication that there is some activity that's not happening in the process of granting trade credit to your customers. So we need to be focused on what we can control, which is our activity, rather than what we can't control, which is the behavior of our customers. We can influence our customers' behavior, but we don't have any direct control over it. So it's absolutely down to you, and it's in your hands. It's about the decisions and the choices that you make. So what is credit management? So credit management, if you straightforward definition here, it's the granting of credit. Now, in terms of when we think of credit, a lot of people think loans, but actually if you offer time to pay, so in credit terms, then you are offering credit to your clients. You're giving them your stuff or your time, and expecting payment at a later date. So you need to manage that very carefully. And even if you are asking for payment on delivery, you are still investing before you've received payment. You're investing money into shipping goods or anything like that, and you're investing time into providing a service before you've requested payment. So it's really important that you are confident that you are going to get paid. So we're looking at this. So credit management is all about how you go about setting credit terms, how you go about recovering them, so collecting the money in when it's due, and how you track how well you're doing, really. So often credit is used as a means of increasing sales, and it's a fine balance. It's a bit of a tightrope walk between increasing your sales and protecting the profit of the business. So credit management is all about trying to be able to do both as safely as possible. So Peter Drucker, I like this quote: efficiency is doing things right, effectiveness is doing the right things. So we can be doing things right as much as possible, but actually if we're not doing the right things, then we will always end up with the same problems. I think one of the adages that I quite like as well is that sayings that I quite like is if you always do what you've always done, you'll always get what you've always got. So actually, if we want to change the outcome, we need to change something that we are doing to make that outcome different. So under credit management, there are 5 pillars. Today, I'm going to focus on talking about the first 2, prevention and operation. But to go through them all just very briefly. So prevention is the things that you can do before you've even started doing business together, or it's part of the onboarding process potentially. So it's all of that activity and those conversations that you do before you've started transacting the business. Then operations is all about how you manage that relationship, and the things that the activity that you do, the things that you do after you've delivered the work, after delivered the goods, to manage that credit and to make sure you get paid on time. Detection is all about checking out for warning signs, because with all the goodwill in the world and all the due diligence that you might do, things change. We can see, that the economy is having an impact on different businesses in different ways. One day, you might have a client who's cash rich and doing really, really well, and then their biggest client, falls over, goes insolvent, and therefore they are then starting to struggle to pay their own bills, and that knocks on down the line. So the detection is all about the tools that you can have in place to make sure that you spot those early warning signs, so you can start having conversations and making decisions as early as possible. Integration is all about how the credit management and the protection of the profits is embedded across the whole business. It's not just one person's responsibility. It's not or one team's responsibility. It's up to the entire business to make sure that we protect the profits of that business. Otherwise, no profit, no business, no job. So it's quite straightforward. And integration is all about how we make sure that all the credit management is aligned across all departments, and aligned with things like how you treat your suppliers and the supplier terms and things like that. So it's making sure that it's aligned right across the business. And then review is how you make sure that stays relevant to your business. How does what your credit management policy and your procedures, how do they stay relevant to the business? Are they always fit for purpose? So a process or a policy is never something that's static. It has to evolve as the business evolves, as the market evolves, as the economy evolves. And sometimes you might want to make changes that are temporary to deal with a short-term situation, and other times it will be a longer-term change that you're looking at. So starting with prevention then, so the old adage, prevention is better than cure. Prevention is all about, as I said, those activities that you have in place, the things that you do prior to actually transacting any business. So that's even signing contracts, then through to signing contracts, then through to information gathering, before you've even done a piece of work or sent a single widget out the door. It also is about having a clear steer on some of the things that you would do in the event that changes happen in your client's behaviour and that sort of thing. So the first step, I always say, is about the information that you would want to take from your customer. So some of this is taken in order for you to be able to do the due diligence, and some of it is then for you to be able to understand how they will operate and whether that will actually align with the way you want to operate. So first and foremost, who are you doing business with? What is the correct legal name of that business? And that even includes down to having the limited bit right. So companies at Companies House will be registered differently. Some will have LTD, some will have it written out in full. But I've seen businesses who have come a bit of a cropper when they've got to a stage, unfortunately, where they need to take some form of legal action, but it's been rejected by the courts because they've not got the correct legal name. So bear in mind that the trading name and the legal name might be different. So as an example, my business is Confident Cashflow, but that's a trading name. The legal name behind it is NK Credit Consultancy Limited. So making sure you understand who it is that you're doing business with. If your business is a sole trader or a partnership, you need to understand the proprietors of that business and any trading name that they then trade under. Other things to consider are the addresses. So you might have 3 different addresses. You might have a registered office address, a delivery address, and a different address to send the invoices to. Now, I know we all do things generally by electronic communication these days, but it's still good to have those physical postal addresses. You might also want to take the details of the key directors involved of the business, because using that information, you can do due diligence around them as well, and get an understanding and a feel for their experience as a director and how that might impact on the way that the business and your customers will be run. So, and then other information that would be really useful for decision making are things like what's their payment process. So how many hoops does your invoice have to go through before it actually gets to the point of being paid? Generally, the bigger a business, the more stages and steps it has to go through, so the longer that process takes. If you understand the process, then if you get to the point where you're having to chase for payment and you're told that the payment it's delayed because it's stuck in the process somewhere, you can go straight to that part of the process and the person responsible for that to try and unstick it and get it through to payment. And importantly, alongside this is, do they have specific payment run dates? So are they making payment, say payments once a week on a Friday, once a month at month end? And are they able to make ad hoc payments as well? And if you're told, for instance, that their payment terms or that payment run dates are done at month end, and they're not really amenable to doing ad hoc payments, you might need to consider whether that's something that your business can manage, because if your terms are 14 days from date of invoice, then the only time you're going to get paid on time is if you're issuing your invoice on, say, day 15 of the month. So you need to then think, is that a deal breaker? Can you manage that? Can you incorporate that into your cash flow forecasting? Can you push back on it? How hard can you push back on it? How hard do you want to push back on it, and see if you can negotiate something different? Invariably, businesses will not want to have lots of different payment dates for lots of different suppliers. But it's always worth asking the question. And if you can't live with it, that's the time then to walk away and say, I'm sorry, no, you can't progress this. So that information is really important to making a decision, and it's something that's very rarely asked. And it isn't until your invoice is two weeks late and you're ringing up to find out why that you find out that they've got these specific payment run dates. Other information then that you need is things like the accounts payables contact details. They're going to be the most important person to talk to about getting paid, and when they work, because not everybody in accounts payable works every day of the week, and it's no point in you ringing up to chase on a Monday when they only work Tuesday, Wednesday, or something like that. So that's really important too. And finally, do they require purchase order numbers? Again, there's nothing worse than ringing up to get finance to get payment, only to be told no PO, no pay. And by this time, the buyer, who should have provided you with the PO, is not incentivized to get you on retrospectively, because they've got what they needed already. They've got the goods or the services already, so they're not really incentivized to get a PO for you. So if you know that information up ahead, you decide whether you want to take that harder stance of no order without a PO, and then you're protected when it comes to the other end of the payment cycle. This particular quote from Knievel is quite a good one. Risk is good, not properly managing your risk is a dangerous leap. And credit management is all about risk. It's not about saying no, and very often we have been referred to as the sales prevention team, but actually it's about finding different ways to say yes, based on how risky that is to your business and how profitable it could be. So it's weighing up that risk versus profit and finding ways to do that business safely. So the sources of information that you can get to do your due diligence, which is the first step in finding out about the risk, there's quite a broad number of places that you can go to. Some is paid for, some not. So the one that's really obvious for paid for source of information is credit reference agencies. They're very good in having up-to-date information, generally about things like any financing, any loans, or any charges that the business has, any CCJs the business might have, information on the directors' past involvements with other businesses, information regarding potentially their payment habits, so tell you whether they're generally a good payer or a late payer. They will still use the financial data that is filed at Companies House, so that could be a little bit out of date, but it does look at some of the financial ratios and things like that as well. And they will also take into account things like media reports and things like that. The algorithms are really, really complicated, and I don't profess to understand them at all, but they take into account hundreds and hundreds of different types of data and sources. So very much worth doing, and they will give you an idea of a potential credit limit, and most of them have a sort of a RAG status, a red, amber, green status, as to how much of a risk they think they are. Companies House is another source of information. Bear in mind, it is just a filing cabinet. So Companies House at the moment don't have any powers or any responsibility to check the validity of the information being filed there. But actually, it's a good place to check for things like making sure you've got the correct legal name and the proper names of the directors and things like that. For a limited company, you take up to 9 months to file a set of accounts, so they're going to be quite out of date by the time you get them. But if they've got previous years, you can see trends and see and basically understand if the company is looking like it's growing year on year, if it's fairly stable. Another source of information will be social media. So what is the company talking about? What are the directors and employees talking about of that company? So are they sharing good news stories? Have they got new product development? What are they actually talking about? And what are their reviews like? So are they getting good reviews? Are there any negative ones in there? How did they respond to the negative reviews? That sort of thing. So that gives you a feel for that organization. And the mainstream and industry-specific news outlets, again, what are other people saying about them? Is there any controversy in the news? Anything, so if you're reading that they're making a load of redundancies, you can go in and ask the question, why? Redundancies don't necessarily mean the company is in financial difficulties. There are lots of reasons why redundancies might happen. Two companies merge and you've got lots of duplicate roles and things like that. So actually it provides a trigger for asking questions. So what's being said there? Next one is your network. So I would always go out to my network first to see if anybody else is working with them before I would think about asking for trade references. I'm not a fan of trade references because trade references can be cultivated. So imagine a business will pick on a couple of suppliers, make sure they're always paid on time, make sure that they are always compliant, always doing what is expected of them, so that whenever somebody else asks them, they can just roll out those two references and will always be given a good report, when they could be treating all of their other suppliers really, really badly. But because they're the two that they always trot out, that can get hidden sometimes. By going to your network and finding out who else they're working with, then actually you can get a more realistic viewpoint of what they are like to work with. And finally, the customer. As I said, some of these things like the social media and the mainstream news, all of those things, provide you with a reference point, a trigger to ask questions. And if Companies House and the Credit Reference Agency reports are saying it's a marginal risk, you maybe wouldn't want to do it. You've got the option then to ask the customer for their latest management accounts so that they can demonstrate that actually things are on, turning around and improving. And with that, then, you can make a better credit decision. If the customer refuses, then that in itself gives you a little bit of a warning about them being more secretive about their current financial situation. And really, it's just all of this information is just about finding the data that you need to make a decision. So, and in making a decision, it's not a question of one size fits all. So as I said earlier, it's not just a yes or no. There could be a yes, but yes, this is the process. Yes, this is where we want to be. And we do that by segmenting our customers. I've suggested here that we segment by that risk so that you can potentially think about having maybe different credit terms with a client, and then you'd have a different process for monitoring and managing that relationship. So if it was a high risk client, so the financials and everything made it sound really high risk, but actually there's a really good profit margin. So actually, if you can get in there and get some good short-term wins, that will outweigh any potential bad debt, any losses later down the line. Then you might want to say, right, okay, we're going to do this, but we're going to shorten our terms and have lots of smaller stage payments, or we're going to have a lower credit limit. But whatever it is you do to try and minimize that risk, but allow you to take advantage of that opportunity for profit. And clients like that you might have on a priority list for review and for regular conversations and whatever the process is for credit control. So at what point do you get alerted for things for that high risk category? Lower risk customers, you might have a slightly lower touch points because they're more likely to pay you regularly. There are lots of other ways to segment your customers. It could be by their payment habits. It could be by their turnover, so the amount of business that they're actually placing with you. But for each one, you would have a different set of processes. So for the higher risk customers, you wouldn't accept payment one day late because okay, it's only one day. What does that matter? But one day becomes 2 days, becomes a week, becomes a month, and the longer it drags on and you're not keeping on top of it, the harder it gets to get that money in, and the more risk there is to your business. And alongside that, then, is the terms and conditions piece. So T's and C's are your setting out your stall, if you like, setting out how you are prepared to do business with somebody. One of the things that I see a lot of is businesses that do a lot of verbal agreements or backwards and forwards by email. And the problem with that is sometimes you lose focus on what was promised to be done by when and how. So having a written set of T's and C's really makes puts that certainty in place. So the client knows exactly what they can expect of you, and you know exactly what you've laid out and specified your client needs to do in order for you to be able to deliver. So the client understands what's expected of them as well. So it's that whole certainty piece. This is what we're going to do, when and how. It helps you to be compliant as well. So you might be in an industry where you've got to comply with certain regulations. So the terms help you to ensure you're compliant. If you're doing business with consumers, you need to make sure you're compliant with consumer contract law. And if you are offering installments and charging interest on it, then you should be registered with the Financial Conduct Authority, and you need to make sure that you are compliant with consumer credit regulation. So it also makes sure that it's very clear what's expected and what responsibilities people have and what liabilities you might have. So each party. So as an example, in your terms, you might have a list of things that you expect your client to do, and you will also have in there the fact that you can't be held responsible for not delivering on your side of things if the client hasn't done all the bits that they were supposed to do that would enable you to deliver. So you've got all the nuances in there are really taken away, and it's very clear. It's black and white as to what has to happen and when. And then there's the confidence thing. So I've seen before in businesses that they feel that having formal contracts like this, T's and C's, is off-putting, but actually it makes you seem more professional, and it can instill confidence in your customers that you are professional, that you know what you're doing, that you are going to deliver and do what you said you were going to do when you're going to do it, and that they're going to get quality, because you wouldn't put it all down in that in that format, in that way, if you weren't going to deliver. And it creates consistency, so your customers get a consistent experience every time that they work with you. And going back to that point about making sure that your customers really know what to expect of you. Excuse me. It's also very useful to make sure that if you do have any negotiations in between all of this or additional to it, that you make sure that they are written out in a separate document. So in your proposals, you can add in extra terms, or you can flex and tweak the terms that are in your main T's and C's. So if you need to treat customers differently for whatever reason, then you can do so. It's not rigid. You can flex them as you see fit. Okay. And we wrap all of this stuff up in our credit policy. And no business is too small to have a credit policy. A credit policy is just the framework that you use for making decisions about who gets credit terms, who doesn't, and how you're going to work with them and manage them. So it provides a bit of control and ownership. So who's responsible for what, and how, and who's responsible for policing it, monitoring it, and that sort of thing. It will outline the documentation that's needed, so whether that's your T's and C's, your customer application form, also things like letters that might go out, or your email reminders, that sort of thing. It talks about how you're going to execute that credit policy. So what's the process that a customer will go through to get from an inquiry through to actually being a customer. And it looks at how you're going to monitor and keep track of the credit terms that you've been offering. It's essentially a set of rules about how you do business. But one of the really important things that should be in there is who's allowed to break the rules as well. So in the whole who's responsible for what, it might be that, you know, certain people in the business can agree to giving credit facilities or credit terms for a business for a credit limit of, say, £1,000. But if you want to go more than £1,000, then the only person that can do that is the MD or the FD. So it's and it's about, you know, who has the authority to do what, and the, you know, say who has the authority to break the rules. After all, there's no point in having rules if you can't break them once in a while, but you break the rules for a good reason. So and the document, again, your credit policy document is a living, breathing document. It's not a something that gets written up and I used to say lost on in a LeverOx file on a shelf, but actually it's more likely to be on a shared drive or something like that these days. But it's not a document that just sits there and gets dusty or virtually dusty. It's a living, breathing document. It helps to make decisions. It helps to make take the emotion out of some of the decisions as well. It encompasses so much about what you do if you don't get paid, what your options are, how you monitor it, what targets you want to set, all of those sort of elements all around that whole offering of credit terms. So what do you currently do to check that your customers are willing and able to pay you on time? How much of what we've just talked about is already in your business? And what things could you be thinking about changing or adding into your business model to make your decision making quicker and easier, and to take some of the risk out of it? So moving on to operations then, this is all about getting things done. What are you doing on a day-to-day basis to make sure that now you've offered the credit and you've started delivery and everything, that you're actually going to get paid? So this is the stuff that is the day-to-day admin almost of credit management. So first of all, it's the information that you have. So how do you track activity? So somebody's sending out invoices, ringing up, asking for payment. There's orders going out, all of that sort of thing. So where is that information held? How do you track that? And do you have a diary system or a task system so that people can see who's done what and when, so that when they go to have a conversation with the client, then they know what's already been agreed, they know what's already been discussed, they know the current situation for that client. So where is it stored, who has access, those sorts of things. So we're talking about, conversation maybe, say for the credit controller. Credit controller has called the client and the client has said, yes, payment will be in your bank on Friday. That's absolutely fabulous. Or the customer then says, oh, we can't pay you because we've not been paid. So that information needs to be available to other people in the business so they can make decisions. So where are you storing that? Who has access? Systems like Xero, you can put notes against invoices or against an account as a whole. It's if you've in different bits of software, that might be somewhere else. And who gets to see that? Who knows how to access it? That's the thing. And the static information. So the information that you had on that form at the beginning of the relationship, how is that kept up to date? How do you make sure that if your credit control person, again, is ringing up to ask for payment, and they're ringing for somebody or they're emailing for somebody that doesn't exist in their business anymore, and you only get told 6 months down the line that so and so left, back in February, then how do you make sure that it's kept up to date? So my recommendation is always to have on an annual basis, go back out to your clients and ask them to reconfirm all of that information. just to make sure that you've got it up to date and that it's still appropriate, and that you then have that available. Again, where do you keep that information? Is that updated in a CRM? Is that updated in your accounting software? Where do you keep that information? So and who can access it again? Then the next really important thing is invoicing. So I've seen it in smaller businesses where you've got one person or a couple of people trying to do everything and juggle all the plates. Invoicing is very often the thing that gets pushed to one side because it's a dull admin task, but actually it's so important, because without sending your invoices out, nobody is going to pay you. There are very few businesses that would pay you without an invoice, because actually, why would they? You want to keep the money in your bank account that bit longer. So, and it's something that sometimes only happens when the bank account's looking a little bit light, and suddenly you realise that stock of that pile of sort of worksheets that you've done, you need to actually do the invoicing for and get that out the door. But when you're doing your invoicing, obviously there's a big long list of things that need to be included legally on your invoice, which you can find on the government website. And all of that will be, if you're using software like Xero and QuickBooks and that they will automatically populate with all of that, the legally required information. But what does your customer need on the on that invoice to be able to make them able to pay it? Do they need detailed descriptions of the goods and services, or are they happy with a summary? Do they need to have, as we go back to the PO number, do they need to maybe see their VAT number on there? I've known some businesses who need that VAT number on there, so just to check that it's a valid invoice. All manner of things. So what do they need? And things like, if they're using an invoice portal that you have to upload your invoices to, then actually certain fields have to be populated in certain ways so that the portal can read the invoice and then pop it into their system. So, what do they think? Establish what your customer needs. When should you be doing your invoicing? Well, when is really more is more about making sure that it's done regularly. My advice is always to do it as soon as you've sent the goods or completed the job, but that's not necessarily always practical. So I would always recommend ring fencing some time that's non-negotiable in your diary at least once a week to do invoicing. Regarding when, if you've got a client and you have agreed that you are going to put up with their insistence that their terms are, say, 30 days end of month following, if you invoice on the 1st of the month, your invoice is not going to get paid for 60 days. By changing the day on which you invoice to one day earlier, either last day of the previous month, your invoice will get paid in 30 days. So the timing of when you send your invoices is really important as well. If you've got clients who have, if you've got, clients who've got non-negotiable terms, if you like. So, and you have agreed either by actual informed consent or by tacit consent, by just carrying on doing business with them, then you need to make sure that you're very mindful of when you do your invoicing. And then how do you send the invoices? And this includes where as well. So very often we are dealing with somebody else in a business who's responsible for buying. If we send the invoice just to them, it could end up sitting in their inbox for ages and not get past the person who's actually going to make the payment. So I will always send it to the client's accounts department as well. So either a specific contact maybe, but always definitely, if they've got a generic inbox, say accounts at or invoices at, then that's the place to send it, because that's the place that will make sure they get it. Going back to this idea that people come and go in a business, if you're sending your invoices to Nicki at and Nicki left the business 6 months ago, then your invoices are just going into a black hole. Whereas if you send them to accounts at, somebody is always monitoring that inbox. Really important to where to do. And a big top tip, it's not something that's legally required to be on your invoice, but always put the due date on. Again, invoicing software like Xero and QuickBooks will automatically put a due date on, but some bespoke software and if you're still doing manual invoicing, putting the due date on will make such a big difference. If you've just got on there that your terms are 30 days, the question then arises, 30 days from when? 30 days from the invoice date, or from when we received the invoice, or from the end of the month? Whereas if you've got a very specific date on there, there's no room for misunderstanding. And it can make such a big difference because people can then schedule their payment for that date and it's ready to go out. And finally, the big piece at the end of it all is the credit control. Now, you hope that you're not having to do too much credit control, because if you've done a lot of the work up front, then the credit control piece should just be a question of gentle nudges and reminders, really, rather than anything really heavy. Now, credit control encompasses a wide range of things. Some of it might be email reminders, automatic reminders out of your accounting software, but that's not the only thing that you need to do. So, and you need to be doing it consistently. Consistency is always key. It's the biggest thing. And don't hide behind email. Pick up the phone. Have a process. So you might have had say 1 week before, send an invoice, an automatic reminder just saying your invoice is falling due for payment soon. Just wanted to check you'd received it, and that it's going through your approval process. I would say that if it's the first time you've ever sent an invoice to that customer, phone them and ask them that question. Make sure that it's got there, it's got through the right system, and that you've sent it to the right place. You might then have a due date reminder, saying just a reminder that your invoice is due today, due for payment today. But as soon as it starts to go overdue, you need to start picking up that phone. Don't hide behind the email. Have those conversations. Pick up the phone. If there's no answer, then by all means follow up with an email and diary to try again and the day after. If you get through to them and they make a promise, you diary that promise and you follow up if it's not fulfilled. If they say they'll get back to you and they don't give you a date, a specific date as to when that's going to happen, then use tactics like saying, that's brilliant, thank you very much. If I haven't heard from you by lunchtime tomorrow, I'll give you another call, and make sure you do that. So you set the deadline if they don't give you one. It's really important to get firm commitments on things, even if that's just a follow-up date. And always make sure you follow up if something doesn't happen when expected, or if you've said you will follow up. If you don't, all you're doing is teaching your customers, your clients, that late payment or payment on time is not important to you, and that you're okay with it being a bit late. And what we don't want to do is educate our customers into being a bit lazy around payment. We want to make sure that we are always showing up and making it very clear what our expectations are. So consistency, consistency, consistency. So do you have a policy and processes for managing your credit risk? Have you got those credit control processes? So it's time for any questions. Quickly before I move on, I'm going to just show you this. So if you found this useful, then please sign up to my email list to get tips on a regular basis. I promise you, I don't spam you. You can unsubscribe at any time. I'm not going to sell at you. I'm just, it's just providing lots of useful information. If you've taken some value from this today, why not connect with me on LinkedIn? And I'd be really grateful if you'd leave me a little recommendation as well, because these sort of things are the lifeblood of the small business.